time now for charting futures, which means it's time for Abigail Doolittle. And Abigail, today you're focusing on bonds.
Indeed we are, Scarlett, because not only do we have Ciana of Bank of America Merrill Lynch, who is an award-winning analyst on bonds and rates, we also have the first up day for bonds, not yields, in 4 days. Take a look at this 4-day chart of the 10-year yield, and you'll see that rates have backed up by 12 basis points. Today, bonds are rallying a little bit, so giving back a couple basis points. But the bigger question, you can see we're sort of close to 2%. Are we about to see a bond sell-off after this year's major rally? Now, Paul's had a great call, so I'd like to present one of the charts that he has presented for us in Smart Charts more recently. So here's the big rally in bonds this year. Paul had it right all the way with yields falling, going from 3% close to below, actually, 1.5%. Now it appears that we have some sort of a bottoming pattern. Last week when Paul joined, he said that so long as the downtrend, in other words, the uptrend for bonds, but the downtrend for yields, that's in place, keep buying bonds. But if that uptrend, or excuse me, downtrend is pierced, at that point you might want to respect it. Maybe his view would change. You can see it was pierced just a little bit yesterday in that 3-day rally for rates, not for bonds. Today, respecting it. To talk more about this and what could be next, let's bring in the man himself, Paul Ciana of Bank of America Merrill Lynch. Thank you so much for joining us. So that downtrend right there is holding pretty much like a glove, but it appears as though maybe the sellers of bonds are going to kind of try to pierce through it and maybe go back up through 2%. What do you think?
I think it's going to be a place now in the bond market where we can play both the short side and the long side.
So you're getting tactical.
That persistent, exactly, and that's where technicals can really shine. That trend following picture that you just showed, it was easy for us to say, keep buying, keep buying, keep buying. Mm-hmm. But now we have that triangle structure that's formed, mm-hmm. and that notch above that 1.85% level on that trend line. I think that's the signal for the technical traders to start trading the market much more.
Let's take a look now. This is the 5-year Treasury. So this is the inverse, but on the 5-year Treasury note futures.
Correct. So in prices, right, bond prices have been rising. Bond yields have been falling. That same trend line here, which is depicted on the 5-year yield chart, is now broken, as you can see, based on the sell-off in the bond market over the last few days and that rise in yields. So that break of that trend line is one of the next pieces of technical evidence that suggests 5-year Treasury might be double topping, which means 5-year Treasury yields might be double bottoming.
So you are recommending right now, based on that trend line breaking and that possible bearish for bonds, not rates, bearish for bonds pattern there, shorting. What level are you looking at?
So we're short. We have our stop now revised down to our entry at 119-10. I think if we continue to trade lower here, we can get at least to that 200-day moving average. If not, potentially down to that 116 figure. So that's actually a sizable sell-off in the bond market, which would certainly take something like 10-year yield north of 2%. Probably somewhere between 2.1 to 2.3%.
That would indeed be a pretty significant move. So again, a tactical short at this point within a longer-term uptrend for bonds. Although who knows, maybe if it pierces that 200-day moving average, we could be having a different conversation. Right. But you're also looking at CFTC positioning to support your view. So talk to us about this chart, please.
So let's think about what happened this year, right? The bond market had such a substantial rally that we went from a very, very short bond market at the end of 2018 to a relatively long bond market this summer. In fact, the net positioning adjusted for open interest right now is at about a 4-year high. So where on the long-term scale, this measure says positioning is sort of neutral or flat at about 0. The bond market went from so short to essentially so long in such a short span of time. Even if we give up a quarter of that positioning, yields are going to be higher than where they are now.